Z. Demonstrate understanding of the matching principle and apply it to specific situations. The matching principle requires expenses to be recognized in the same period as related revenues. This principle ensures accurate measurement of net income. For example, cost of goods sold is recognized when the related sales revenue is recorded. Matching enhances comparability and prevents distortion of profitability across periods. Certain expenses are estimated to achieve proper matching. Warranty costs, bad debts, and sales commissions may be recognized in the same period as revenue, even if cash payment occurs later. Accrual accounting requires recognition of these obligations when revenue is earned, not when cash is paid. When direct matching is not possible, systematic allocation is used. Depreciation and amortization allocate asset costs over periods benefiting from their use. Period costs, such as administrative expenses, are expensed as incurred because they cannot be directly linked to specific revenue. Applying the matching principle ensures accurate profit measurement and reliable financial reporting. Define gains and losses and indicate proper financial statement presentation. Gains and losses result from peripheral or incidental transactions. Unlike revenues and expenses, which arise from primary operations, gains and losses stem from non-core activities such as asset disposals, litigation settlements, or investment revaluations. Gains increase equity from non-owner sources, while losses decrease equity. They are recognized when realized or when required by fair value accounting standards. Presentation depends on nature and materiality. Gains and losses are generally reported in the income statement within income from continuing operations unless related to discontinued operations or other comprehensive income. Material items may be separately disclosed to enhance transparency. Proper classification ensures users can distinguish recurring operating performance from non-recurring or peripheral events. BB. Demonstrate understanding of treatment of gain or loss on disposal of fixed assets. Gain or loss equals the difference between proceeds and carrying amount. When a fixed asset is sold, its book value, cost minus accumulated depreciation, is compared with sale proceeds. If proceeds exceed carrying value, a gain is recognized. If lower, a loss is recorded. This amount is reported in income from continuing operations unless related to discontinued operations. Depreciation must be updated before disposal. Accumulated depreciation is adjusted to reflect expense up to the disposal date. The asset and related accumulated depreciation are removed from the books. This ensures accurate measurement of carrying value and prevents distortion of gain or loss calculations. Cash flow classification reflects transaction nature. Proceeds from sale are reported as investing cash inflows. The gain or loss itself is non-cash and is removed from operating cash flows under the indirect method. Proper treatment ensures accurate income measurement and statement of cash flows presentation. CC. Demonstrate understanding of expense recognition practices. Expenses are recognized when incurred to generate revenue. Under accrual accounting, expenses are matched with related revenues in the same period when feasible. Cost of goods sold, commissions, and warranty expenses are examples of directly matched costs. This approach ensures accurate measurement of operating performance. Systematic allocation applies when direct matching is impractical. Long-lived assets are depreciated or amortized over their useful lives, allocating cost across benefiting periods. This prevents distortion of income in the period of purchase and reflects ongoing resource consumption. Immediate recognition applies to period costs. Administrative salaries, research costs, unless capitalized, and advertising are expensed as incurred because they cannot be directly tied to specific revenues. Consistent application of these recognition practices supports comparability and faithful representation. Define and calculate comprehensive income. Comprehensive income includes all changes in equity except owner transactions. It consists of net income plus other comprehensive income, OCI. OCI includes certain gains and losses excluded from net income under U.S. GAAP, such as unrealized gains and losses on available-for-sale debt securities and certain pension adjustments. Calculation begins with net income. Comprehensive income equals net income plus or minus items reported in OCI during the period. These amounts accumulate in equity as accumulated other comprehensive income, AOCI. The total reflects overall economic performance, not limited to operating results. Presentation may be in one or two statements. Companies may present a single continuous statement of comprehensive income or separate income statement and statement of comprehensive income. This flexibility ensures transparency while highlighting broader performance measures. Identify the correct treatment of discontinued operations. Discontinued operations involve disposal of a strategic component. A component whose operations and cash flows can be clearly distinguished may qualify if disposal represents a strategic shift with major effect on operations and financial results. Examples include sale of a major business line or geographic segment. Results are reported separately from continuing operations. Income or loss from discontinued operations, including gain or loss on disposal, is presented net of tax below income from continuing operations. This separation improves comparability and allows users to evaluate ongoing performance. Assets and liabilities held for sale are separately classified. Once criteria are met, assets are measured at the lower of carrying amount or fair value less costs to sell, and depreciation ceases. Proper classification enhances clarity regarding future earnings potential. Identify and describe major GAAP versus IFRS differences and their impact on analysis. Expense recognition differences, share-based payments, and employee benefits. Both frameworks recognize share-based compensation at grant date fair value, but measurement details and forfeiture estimates may differ. For employee benefits, IFRS generally recognizes actuarial gains and losses in other comprehensive income without subsequent amortization, while US GAAP may allow amortization approaches. These differences affect volatility in income and equity, influencing profitability ratios and trend analysis. Intangible assets and development costs. IFRS permits capitalization of development costs when technical and economic feasibility is demonstrated, increasing assets and deferring expenses. US GAAP generally expenses research and development as incurred, with limited exceptions. IFRS also allows revaluation of intangible assets to fair value if an active market exists, while GAAP prohibits revaluation. These differences impact total assets, earnings patterns, and return on assets comparisons. Inventories, costing methods, valuation, and write-downs. IFRS prohibits LIFO, whereas US GAAP permits it. In inflationary periods, LIFO under GAAP lowers income and taxes compared to FIFO or weighted average under IFRS. IFRS applies lower of cost and net realizable value, NRV, while GAAP uses lower of cost and market, LCM, for certain methods. IFRS also allows reversal of inventory write-downs. GAAP prohibits reversals. These differences affect comparability of margins and asset values. Leases and long-lived assets, revaluation, depreciation, borrowing costs. Both frameworks recognize right-of-use assets and lease liabilities, but expense classification differs for lessees. GAAP distinguishes operating and finance leases, different expense patterns, while IFRS generally applies a single finance lease model for lessees. IFRS permits revaluation of property, plant, and equipment and requires capitalization of borrowing costs for qualifying assets. GAAP prohibits revaluation and has more limited capitalization rules. These differences affect leverage, asset turnover, and earnings trends. Impairment of assets, determination, calculation, reversal. GAAP uses a recoverability test based on undiscounted cash flows before measuring impairment loss at fair value. IFRS uses a one-step approach comparing carrying value with recoverable amount, higher of fair value less costs of disposal or value in use. IFRS permits reversal of impairment losses, except goodwill, while GAAP prohibits reversals. These variations influence reported asset values, income volatility, and cross-border financial analysis.